Never trust a perfect setup on a 5-minute chart. It's probably the reason you keep losing money. The market isn't random, but the way you're trading it might be. You're about to learn the one rule that separates traders who slowly bleed out from those who quietly build real wealth over time. And once you see this, you won't be able to unsee it. You've probably experienced something like this. You're sitting there watching the charts, and suddenly everything lines up. The pattern looks clean, your indicators agree, the entry feels obvious. It feels like one of those trades you just know is going to work. So you take it, and at first, it even looks good. Maybe it moves a little in your favor. You start thinking, okay, this is it. Then out of nowhere, it turns. Not always instantly. Sometimes slowly. But eventually, it goes against you hard enough that you're forced out of the trade. And you're left wondering what went wrong. Here's the part most people don't realize. The setup itself wasn't necessarily bad. You were just looking at the wrong time frame. This is one of the biggest reasons traders struggle, and it's not talked about enough. I've seen people who are genuinely smart, disciplined, and experienced still lose money over and over again. Not because they don't understand charts, but because they're focused on the wrong layer of the market. At the same time, I've seen much simpler traders, people who don't overcomplicate things, do really well. And almost all of them follow the same idea. They respect the higher time frame. Let me explain this in a way that actually sticks. Imagine you're standing at the beach. Right in front of you, you see waves moving constantly. Some are small, some are bigger, some move forward, some pull back. It's always changing. That's what lower time frames look like. The 1 minute, the 5 minute, they move fast, they react quickly, and they can change direction without warning. But if you take a step back and look at the ocean as a whole, there's something much bigger happening. The tide. The tide is either coming in or going out, and it doesn't care about the small waves happening on the surface. Now here's the problem. Most traders are making decisions based on the waves, without paying attention to the tide. So they buy because they see a strong move on a small time frame, not realizing the entire market is actually pushing in the opposite direction. Now you might be thinking, okay, but people do make money on lower time frames. And that's true. But it comes with a condition. When you trade only on lower time frames, you have to be right almost immediately. There's very little room for error. If the trade doesn't work quickly, it usually doesn't work at all. It's a very tight game. But when your trade is aligned with a higher time frame, things feel very different. You don't need perfect timing. You don't need instant confirmation. You can handle small pullbacks because the bigger trend is still supporting your position. This is where things get tricky though. Lower time frames are addictive. They give you constant movement, constant setups, constant opportunities to do something. And doing something feels productive. Sitting and waiting, on the other hand, feels like you're missing out. But in trading, those feelings can be misleading because being active is not the same as being profitable. I learned this the hard way. There was a time when I thought the key to making money was taking more trades, spotting more setups, and staying constantly engaged with the market. I would jump in and out of positions, always looking for the next opportunity. And for a while, it felt like I was improving. But over time, the results told a different story. I wasn't building anything. I was just cycling through wins and losses, slowly draining my account. It wasn't until I stepped back and started focusing on higher time frames that things began to change. I remember one specific trade that really shifted my perspective. I had identified a strong trend on the monthly chart. It was clear, steady, and had been building for a long time. But instead of waiting for everything to align properly, I dropped down to a lower time frame and entered early. I told myself it was just a small position, nothing serious. But the market moved against me almost immediately. I held on, thinking the bigger trend would save the trade. but the timing was off. The structure wasn't aligned yet, and I ended up taking a loss. That experience taught me something important. It's not enough to be right about direction. You also need alignment across time frames. Here's a simple way to think about it. The higher time frame tells you where the market is going. The mid time frame shows you how it's getting there. And the lower time frame helps you decide when to enter. Each one has a role. Problems happen when you mix them up. Another way to understand this is by thinking about a river. If you stand very close to the water, you'll see all kinds of movement. Small currents, splashes, little swirls going in different directions. It can look chaotic. But if you zoom out and look at the river from above, the direction becomes obvious. It's flowing one way. The smaller movements don't change that. Markets behave the same way. Lower time frames show the noise. Higher time frames show the direction. And here's something most traders don't realize until much later. When you trade with the higher time frame, you give yourself flexibility. You can be a little early. You can be slightly off on your entry. And your trade can still work because the overall direction is on your side. But when you trade against it, everything has to be perfect. Your entry needs to be precise. Your timing needs to be exact. And even then, you're fighting an uphill battle. So, what does this look like in practice? A simple approach would be this. Start with the weekly or monthly chart and figure out the main direction. Then move to the daily chart and see how the market is behaving within that direction. Is it trending smoothly, pulling back, or just moving sideways? Only after that should you drop to a lower time frame to look for an entry. At that point, you're not guessing anymore. You're just finding a good spot to join a move that's already in progress. The hard part isn't understanding this. The hard part is actually following it, because it requires patience. There will be times when you don't take any trades at all, times when you just sit and watch. And that can feel uncomfortable, especially when you see others constantly trading and posting results. But most of that activity is noise. And chasing that noise is what leads to inconsistent results. I've seen traders take dozens of trades every week and still not get anywhere. At the same time, I've seen traders take just a few well-planned trades each month and grow steadily. The difference usually comes down to one thing. They're aligned with the higher time frame. There was a period where I held a position for weeks without much happening. Price moved sideways, and it was tempting to close the trade and move on. Meanwhile, other traders were actively trading every small move. But I stayed in the position because the higher time frame still supported it. And when the move finally came, it was strong enough to make up for all that waiting. That's when patience starts to make sense. Over time, this approach changes how you experience trading. You stop reacting to every small movement. You stop feeling the need to constantly check charts. You become more selective, more calm, and more focused. And ironically, that's when results usually improve. If you're honest with yourself, you might notice a pattern. Most of your trades probably come from lower time frames. Most of your decisions are based on short-term movement, and many of your losses happen when those short-term setups go against a bigger trend. That's not bad luck. That's a mismatch in perspective. The market isn't random, but it is layered. And if you ignore the higher layers, the lower ones will confuse you. So here's something simple you can try. Next time you open your charts, don't start with the 5-minute. Start with the weekly. Then look at the daily. Take a moment to understand what the market is actually doing on a bigger scale. Only then should you zoom in. That one habit alone can change the quality of your decisions. Because at the end of the day, trading isn't about finding more setups. It's about finding better ones. And better trades almost always come from alignment with the higher time frame. The market will always move in small waves, but those waves are guided by something bigger. And if you learn to follow that bigger movement instead of fighting it, everything starts to feel a lot more clear. If this helped you, hit the like button. subscribe to the channel, and drop a comment about the one trading mistake you're working on fixing. Are you ready to take your trading to the next level? Click the link in the description now and get started today. In the meantime, watch the next video on the screen. It'll show you exactly how to time your entries once you've locked in the higher time frame direction. See you next time.